So this is problem P15-39B. Basically, we're going to be comparing two companies to determine which one is a better investment. So it's going to ask us to compute a bunch of different ratios that we've learned. So we'll go through those, and then at the end we'll figure out which one was the best investment to make based on the things we're optimizing for. So let's see, we can open up our income statement and our balance sheet, and again you see there's two companies listed here and their respective income statements and balance sheets. So let's start with this. It's asking us what the acid test ratio is. So let's look at our options. So the acid test ratio is basically a way to measure the ability for a company to pay its short-term obligations. So if we look at the list here, cash and cash equivalents, that's a cash ratio. I believe it's this one. Cash, short-term investments. Accounts receivable is on our numerator, and the denominator is total current liabilities. So I think it's that one. Let's move these aside. Okay. So now let's follow the formula for each of these and put in the numbers. So these are all balance sheet, or rather the numbers that we need are on the balance sheet. So let's open that up. So let's do digital plus first. So we have cash, short-term investments, AR, and current liabilities. And so cash for, let's call it DP, which is this digital plus, and red zone. So cash is 24,000. So I got all those numbers from these rows here, and the total current liabilities we're getting from here. Okay, so now let's do our math. So we're going to take the sum of these three divided by current liability and just apply that formula over. So you see here it's the same formula but just for the other company. So digital plus 0.97 and red zone is 0.79. Okay. Okay, so now inventory turnover. Inventory turnover basically is a measure of how many times you're able to churn your inventory through the sales process. So that's measured by a multiple of cost of goods sold. So it's this one, cost of goods sold divided by average merchandise inventory. Okay, so let's check that. Okay. So inventory turnover, so let's go back to our sheet here. So we need cost of goods sold, which is going to be on our income statement. So cost of goods sold, and then we need average inventory. So let's do it like this: inventory end of year, inventory beginning of year. And so these are the numbers we need. So first From the income statement, let's get the cost of goods sold. Inventory end of year is on the balance sheet. Right here. And in the beginning of the year, down here. Okay, so let's now get the average inventory. Okay, so now we have the average inventories. So now let's just take the cost of goods sold divided by the average inventories. So 2.83 and 2.75, or rounded up 76. This is 2.84, so make sure you do the rounding correctly. Okay, next we have days sales in receivables. So this is a measure of basically the number of days that it takes for the kind of median receivable to be converted to cash. So basically this is it's going to be 365 divided by the accounts receivable turnover ratio, which is equal to basically net credit sales divided by average accounts receivable. So let's see if we can find. Okay, so you can kind of tell right off the bat it's given right here, 365, because it's the only one actually with 365 as the numerator, so it's pretty obvious that this is the only legitimate option. Okay. Okay, so basically we have to calculate this accounts receivable turnover ratio and then just divide 365 by that number. So what is the accounts receivable turnover ratio? It's essentially the net credit sales divided by accounts receivable. It's actually very similar to this inventory turnover ratio. Instead of measuring inventory turnover as a function of cost of goods sold in inventory, we're seeing how much accounts receivable is getting turned over depending on the net credit sales. So they're simplifying it for us a little bit. It says all of the sales are on credit. So it's going to be net credit sales, and it's going to be average. Okay, so let's do it the same way. We'll do AR end of year, AR beginning of year. We'll have average AR. Okay, so now let's fill in the numbers here. So we see so I got those numbers from right here, net sales. And then the other numbers we're going to get from the balance sheet. So we go up here. Accounts receivable end of year is going to be right here. And the beginning of the year, we're going to get from down below on this line. So now we calculate the average. And as we divide net credit sales divided by the average AR. And then we have 365 divided by that turnover ratio that we just calculated. And so this is in number of days. So they're very close. This is 35 and this is rounded up 36. So the lower the number, the better. That means you're able to turn over your accounts receivable to cash sooner. So in this case, Digital Plus is slightly ahead because it has one extra, or rather one less day that it takes to convert AR to cash on average. Okay, now we're going to compute the debt ratio. So the debt ratio is simple. It's just liabilities, total liabilities divided by total assets. So we simply can take the numbers. We have total assets, we have total liabilities. So sorry, I did current liabilities. You want to make sure you're taking total liabilities. So we have total liabilities divided by total assets. And so we have 38.8 and 40.7. And again, the lower this number, the better. It means you're borrowing less, meaning your balance sheet is less risky. Now, typically that means that you probably have a lower return on equity. So it just depends on what you're trying to achieve. If you want to have a higher return on your equity, then the debt ratio being higher is not necessarily bad. But if it's purely from a risk management standpoint, then the more debt you have, the more risk that your business is taking on. Okay, so now it's asking us to calculate earnings per share of common stock. So it's going to be earnings per share of common stock is net income minus your preferred dividends divided by the weighted average number of common shares outstanding. So net income minus preferred dividends divided by weighted average number of common shares outstanding. So that looks like it. Okay. Okay, so let's see if we have any preferred stock. It looks like on the balance sheet there's no preferred stock listed. So the preferred dividends are 0. So let's fill in the other numbers here. So we have net income. Now we need the total number of shares outstanding. So it looks like there's 10,000 shares of this Digital Plus and 16,000 shares of Red Zone. So when we do the math, net income divided by the number of shares, $5.40 per share for that, and $4.75 per share for that. So again, these are dollar amounts. It's dollars per share because we have a net income which is measured in dollars divided by a number of shares. So we're going to get dollars per share. Okay, now we have price to earnings ratio. So now we're going to have the market value of the shares coming into play. So let's think about this for a second. What is the formula? It's price per earnings. So you're going to have the price of the stock divided by the earnings per share. So let's see if we can find it. Market price per share divided earnings per share. Okay, so let's go back to our sheet. We've just calculated our earnings per share here. So it tells us the market price is 86.40. So price divided by earnings, price divided by earnings is 16 and 22. Okay, and so what's the intuition here? Let's say you have a toy store that earns $100,000 a year, and someone wanted to buy your business and they offered $1 million. How would you kind of determine if that's a good price or not? One way is to look at the price to earnings. So if your business is earning $100,000 a year and you're offered $1 million, that's a 10x price to earnings ratio. Let's say you earned $100,000 and someone offered you $10 million. That's a 100x price to earnings ratio. So the offer price is really high related to how much your business earns. Basically, if you bought it for $10 million, you would have to own the business for 100 years to recoup your money, assuming that the earnings for the business stayed at $100,000. So a lot of times in public markets, the price to earnings ratio is extremely high. It could be 100 or more, because the market is thinking that, okay, the business is earning, let's say, $100,000 now, but in 2 years it will earn $200,000, and in 3 years it will earn $500,000. So for a lot of businesses that are growing their net income very quickly, the price to earnings ratio may be very high at a particular point in time. So analyzing this ratio is helpful to determine if the stock price is too high or low, but it's more complicated than that because you also have to determine the dynamic nature of earnings of the business to see if it's a fair price or not. So the next is compute the dividend payout for both companies. So basically we want to see what the ratio of the dividends per share are to the market price of the share. So it's basically market price. Let's see. Sorry, I misspoke. The dividend payout ratio wants to see of the net income per share, how much of it is getting paid out as a dividend. So it's the dividends per share divided by the earnings per share. So you want to see if, let's say your business is earning $5.40 a share, are you paying $6 as a dividend? That might be unsustainable because you're paying out more to your shareholders as dividends than you're earning per share. So this ratio is important to see how much the business is retaining for itself versus paying out as a dividend. And if it exceeds 1, then it means it's actually paying out more than it's earning. So that could be an unsustainable situation. Okay, now compute the dividend payout for both companies. Okay, so we basically have our earnings per share here already calculated, and the dividends per common stock is right here. And so the ratio is dividends per share divided by earnings per share. So 22% and 21%. Okay, so I think it's pretty much done with asking us to compute ratios. So decide which company stock fits your investment strategy better. So our strategy is stated here. Your strategy is to invest in companies that have low price to earnings ratios but appear to be in good shape financially. So you would want to buy a low PE ratio company because it's just a better deal. It's like the example I gave of your toy store making 100K a year and being sold for $1 million versus 10 million. If it's a lower price to earnings ratio, in other words, the $1 million, you're just getting a better price for the earnings that you're getting from the company. So we see here that Digital Plus has the lower price to earnings ratio. And let's see if it has better financial health. Yes, it has a lower debt ratio. It has a higher acid test ratio, which is good. So it seems like a no-brainer that Digital Plus fits this strategy better. So this price to earnings ratio is lower. And appears to be in better shape. On the majority of ratios, Digital Plus looks better. Okay, that's it.